Welcome to a world where the economy sends mixed signals, a world where the S&P 500 is yet to reach its record high, but shows promise of soaring higher. This is a world of possibilities and uncertainties, a world that keeps every financial enthusiast on their toes. In this vast financial landscape, the S&P 500 has managed to rebound from its bear market lows, demonstrating resilience in the face of adversity. This resilience is mirrored in the U.S. economy's strong third-quarter expansion, a testament to the country's economic vitality and a beacon of hope for those invested in the stock market. The picture of the current financial climate is further brightened by the low unemployment rates we're witnessing. With more people gainfully employed, consumer confidence tends to rise, and that's a positive indicator for the stock market. Adding to this positive outlook are the increasing wages that have been observed. When wages rise, people have more disposable income, and this extra cash often finds its way into investments, including stocks. But it's not just these macroeconomic indicators that are painting an optimistic picture. If we look closer at the S&P 500, we see a promising trend. Analysts are expecting revenue and earnings growth to accelerate in the S&P 500 in the coming year. This expectation is based on the analysis of company fundamentals and industry trends, and it's a positive sign for those who are considering investing in the stock market. Also worth noting is the reduced mentions of recession on earnings calls. This reduction suggests that many companies are feeling more confident about the economic outlook and less fearful of an impending downturn. But in the midst of these encouraging signs, there are also indicators suggesting a possible stock market drawdown. As we delve deeper into the financial landscape, surging bond yields and the Federal Reserve's slower interest rate cuts paint a different picture. Now, what does this mean? Let's break it down. When bond yields surge, it's like a siren sounding in the financial markets. Higher bond yields mean that bonds become more attractive investments compared to equities. Investors start to think, why risk my money in the roller coaster ride of the stock market when I can get a solid return from bonds? This shift in investor behavior can divert funds away from equities, leading to a potential stock market drawdown. Meanwhile, the Federal Reserve's indication of slower interest rate cuts adds another layer of complexity. You see, when the Fed cuts interest rates, it stimulates the economy by making borrowing cheaper. This encourages businesses to invest and grow, which in turn can boost the stock market. But when the Fed slows down its rate cuts, it can signal that the economy might not be as robust as we'd like. And then there's the inverted U.S. Treasury yield curve, a bit of a mouthful, isn't it? But it's a crucial piece of the puzzle. This curve, which plots the yields on Treasury bonds of different maturity dates, normally slopes upwards. But when it inverts, with shorter-term yields higher than longer-term ones, it's historically been a warning sign of an impending recession. And guess what? This curve has been inverted for the past year. So, we've got surging bond yields, a cautious Federal Reserve, and an ominous yield curve. It's like a storm brewing on the horizon. But that's just one side of the coin. There are also positive indicators like the U.S. economy's strong third-quarter expansion, low unemployment, and increasing wages. In this seemingly confusing financial climate, where do we turn for advice? Well, enter Warren Buffett, a name synonymous with successful investment strategies, who has a simple advice for most people. We're talking about a man who has made a fortune by investing wisely and consistently over the years. Warren Buffett, the Oracle of Omaha, has a wealth of knowledge and experience in the world of finance and investing, and when he offers advice, it's wise to listen. Buffett's key advice for most investors? It's surprisingly simple. He recommends investing in an S&P 500 index fund. Now you might be wondering, why an index fund? Well, the S&P 500 index fund is a type of mutual fund that replicates the performance of the S&P 500 index, a benchmark that includes 500 of the largest U.S. companies. By investing in this fund, you're essentially betting on the overall U.S. economy. But there's more to it. Buffett's recommendation comes from a historical fact that's hard to ignore. Over the long term, most money managers, yes, even the professionals, have not outperformed the S&P 500 index. That's right. Despite all the research, the complex strategies, and the high fees, most professional money managers can't beat this simple index fund. So, what does this mean for you, as an investor? It means that instead of trying to pick individual stocks or time the market, you might be better off investing in an S&P 500 index fund. It's a strategy that's easy to understand, easy to implement, and has proven to be effective over time. But remember, investing is not without risks. It's crucial to do your own research, consider your financial goals and risk tolerance, and perhaps seek advice from a financial advisor. As we navigate this complex financial world, Warren Buffett's advice offers a beacon of clarity. With all these indicators and advice in mind, one question remains: is now a good time to buy stocks? As we navigate through the financial landscape of 2023, we find ourselves in a tug-of-war between optimism and caution. On one hand, we see the S&P 500 rebounding from its bear market lows, a strong third-quarter expansion of the US economy, low unemployment, and increasing wages. These factors shine a ray of hope on the stock market's future and suggest a potential climb. On the other hand, we can't ignore the warning signs. Surging bond yields could divert investors from equities, and the Federal Reserve's slower interest rate cuts add another layer of uncertainty. The inverted US Treasury yield curve, a known harbinger of past recessions, has been inverted for the past year, raising eyebrows among some investors. Then there's Warren Buffett's advice. Known for his successful investment strategies, Buffett recommends investing in an S&P 500 index fund. Why? Historical data shows that most money managers have not outperformed the index. It's a strategy that prizes patience and consistency over quick gains. So, is now a good time to buy stocks? The answer isn't as straightforward as we'd like. It's a mixed bag of potential rewards and risks, opportunities and uncertainties. If you're considering investing, it's crucial to balance these factors against your financial goals, risk tolerance, and understanding of the market. Remember, investing isn't about timing the market perfectly. It's about time in the market. It's about making informed decisions, being patient, and sticking to your investment strategy, even when the market gets a little bumpy. As we delve into the intricacies of investing, it's also important to remember that no one size fits all. What works for one investor may not work for another. What aligns with one person's risk tolerance may not align with yours. So, take the time to understand your financial goals, your risk tolerance, and the market before making an investment decision. The decision to invest is ultimately a personal one, influenced by various factors including financial goals, risk tolerance, and market understanding. As we wrap up this deep dive into the financial world, remember that knowledge is power. We've traversed through the current financial climate, touched upon the warning signs, and delved into Warren Buffett's investing advice. We've also pondered over whether now is a good time to buy stocks. The S&P 500, though it has rebounded from bear market lows, still hovers below its record high, indicating a market that's yet to reach its zenith. We've seen how the economy sends mixed signals, with some indicators suggesting the market will soar higher, buoyed by strong third-quarter expansion, low unemployment, and increasing wages. But we've also discussed potential red flags. The surge in bond yields could divert investors from equities. The Federal Reserve's indication of slower interest rate cuts could impact investment decisions. The US Treasury yield curve, an uncanny predictor of past recessions, has been inverted for the past year, suggesting caution. Warren Buffett, the sage of Omaha, advises most people to invest in an S&P 500 index fund. It's a piece of advice worth considering, but remember, investing is personal. It should align with your financial goals, risk tolerance, and investment horizon. Informed decisions are the best decisions. Understand the market, analyze the indicators, listen to the experts, but ultimately, make decisions that suit your unique situation. If you found value in this video, consider subscribing for more insightful content. Share your thoughts in the comments below. Do you think now is a good time to buy stocks? Your perspective matters. Until next time, stay financially savvy.